Aggregate expenditures part 1 is what this video is. Part 1 of a 3-part video where we'll put together all of the different mechanics of how the aggregate expenditures model works and ultimately how we use it to close those recessionary and inflationary gaps we've already discussed with the aggregate demand, aggregate supply model. So that is ultimately, at the end of the day, what we're looking to do with aggregate expenditures is close gaps, whether they're recessionary or inflationary gaps. By now you should know what this expression here is. We're using Y instead of GDP for a reason. Y is equal to income in many contexts, as I've already pointed out a couple of times. And there's a reason we're doing that instead of GDP, where we're taking GDP down into its component parts in order to figure out what aggregate expenditures has to do with GDP and closing those recessionary and inflationary gaps. So the idea behind why we're doing this, in that previous equation, the GDP equation, if any types of spending in that equation increase, aggregate expenditures will also increase. This is kind of obvious. But of course, it means that GDP will also increase because firms will have to produce more output in order to meet the additional demand that it's perceiving from all of this. And of course, we've already operated with the assumption that we generally expect unemployment to fall when GDP rises and for unemployment to rise when GDP falls. So we've already alluded to the fact that fiscal policy is one of the tools that many economists believe the government should use to try to increase or decrease GDP as needed to close these recessionary or inflationary gaps. And I've foreshadowed multiple times to the fact that we're going to look and see how this works in a little more detail later. And, well, later is right now. We've already seen that fiscal policy, we're going to talk about monetary policy in a few weeks, but fiscal policy, there are 3 specific levers that we separate out. There's the government spending lever, where you can increase spending when you want to close a recessionary gap, decrease government spending or government purchases when you want to close an inflationary gap. You can raise and cut taxes, and you can raise and cut transfer payments. And now we're going to see why. I've pointed out before that there is a good reason that we'll get into later, and later is now. We're going to see why transfers and government spending are not included as the same thing for our purposes. For legislators' purposes, yes. For our purposes, we treat them differently. But we'll get into that in the third part, in the third video. For right now, though, we need to define a couple of terms that might not seem like they make much of a difference, but in the end, we'll see that they make a huge difference. And they're related to what we can do with our income. Disposable income, when we talk about disposable income, that's simply income minus taxes. When a household does its budget, they may think of, or we may think of, disposable income as the income that we're going to spend with, or that we can do whatever we want to do with after we've paid all of our bills. When economists talk about disposable income, it's because in most societies at this point, incomes are not tax-free. Whatever your income is, we're usually talking about your before-tax income. So we say disposable income to make clear that we're talking about whatever your income is after the taxes have been taken out of your paycheck. Those of you who work, you may have already noticed when you get your paycheck, you get a dollar amount that doesn't look nearly as good as a dollar amount you get to actually put in the bank or turn into cash, because a lot of crap gets taken out and taxes are one of the main deductions. So the money that you get after those deductions, that's your disposable income. And we have 2 arrows here pointing in 2 directions. In the long run, we just assume that all income is spent. Savings is just future consumption. But with with all efforts to close recessionary or inflationary gaps, we're dealing in the short run. We're dealing with a situation in which our aggregate demand curve is intersecting a short run aggregate supply curve in a place that is not also intersecting the long run aggregate supply curve. So we are always in the short run when we're talking about fiscal and monetary policy. So in the short run, we can have savings. And that represents just two things that can be done with our income. We can spend it, we can save it, that's it. Again, we don't get into a situation where you can give it away. You may have heard some financial planners, Dave Ramsey is a very prominent one, who will say there are three things you can do. You can spend it, you can save it, you can give it away, and you need to be doing one of all three. That's something he's famous for saying. We don't get into reality in economics classes. You should know that by now. Instead, you can only do one of two things. You're consuming it or you're saving it. If you're giving it away, an economist would simply say, well, you're spending it on the good feelings that you purchase when you donate to charity, which we've already talked about. So you can either consume or you can either save. And the amount that you choose to consume of your income, we have a word for it, believe it or not. That is your marginal propensity to consume. Propensity, if this word is unfamiliar to some of you, it just basically means it's what you're urged to do, so to speak. And marginal, we use this all the time in economics. You should hopefully be familiar with this. This is pointing out that we're just looking at you going from one income level to the next. Maybe you went from not having gotten your most recent paycheck to having just recently gotten your most recent paycheck. So what this is talking about, the marginal propensity to consume, is how much of each paycheck or each additional bit of money that you get, how much of that are you going to go and spend? And how much are you going to save? Whatever savings looks like. If you leave it in the bank, if you put it under the mattress, leave it in your wallet, or whatever, if it's not being spent, it is being saved. In the long run, it'll be spent. In the short run, right now, it's being saved. So, what is your propensity to consume the income you get, and what is your propensity to save it? It is a fraction. Each dollar you get, a fraction of it will be spent and another fraction will be saved. So if 90% of your income is spent, then your marginal propensity to consume is going to be 0.9. The formula here, we recognize these triangles now as Greek letter delta. The change in consumption divided by the change in income. Remember, Y here is defined as income. So as your income changes, how does your consumption change? So, for example, you earn $500 and you spend 100 of it. The change in your income here was 500. The change in your consumption was 100. So our equation becomes, it's 500 minus 0 and 100 minus 0. You were spending 0, then you got some income, now you're spending 100. So that Greek letter delta, again, it doesn't ever need to be scary. It is pretty simple. So your marginal propensity to consume is $100 divided by $500, which is, of course, just 0.2. In other words, 20% of your income was spent. Now, in addition to marginal propensity to consume, we have what is known as the marginal propensity to save. And it's exactly the same as marginal propensity to consume, only now we're focusing on how much you save. So the formula is exactly the same. Your change in income is the denominator, which is saying how much, when this changes, what fraction of it are you going to save? In the example we just went over, your $500 went with you on Friday night, but only 100 was spent. So whether it went with you or not, you only spent 100 of it. The other 400, it wasn't spent in this period. So for this period, your marginal propensity to save is going to be 400 divided by 500. And that is, of course, equal to 0.8. And one thing you may have already noticed, this 0.8 right here, and the 0.2 when we calculated your marginal propensity to consume, after we saw that you spent 100, 0.8 plus 0.2, well, that equals 1. Always and forever, because again, economists say you can only spend your income or you can save it. You're not doing anything else with it. You can't do anything else with it. You spend it, you save it. One of the two, nothing else. Remember, this is a percentage. Essentially, 100% of your income is either consumed or spent. So whatever your marginal propensity to consume is, 1 minus that is going to be your marginal propensity to save. Whatever your marginal propensity to save is, 1 minus that is going to be your marginal propensity to consume. It seems pretty simple. It seems like an obvious thing to point out, but we point it out for a reason. And we're going to see this a little bit more as we get into the formulas for the multiplier effect. But this can be a very useful identity because you are going to face exam questions and other questions that are going to ask you what your marginal propensity to save is, but all you're given is a marginal propensity to consume, and it may seem like you're not given enough information, but thanks to this equation, you are, and it's a very simple calculation to find it. You also may have to calculate a spending multiplier or use a spending multiplier, which we'll cover in video 3, where you're given a marginal propensity to save but not a marginal propensity to consume, and it's expected that you're going to be able to find one when you're given the other, knowing that the two are always going to add up to equal 1. So what does this have to do with closing inflationary and recessionary gaps? It has a lot to do with it, but we'll see that in video 3. But for now, it's important. All you really need to know is what these are until we get to how we use them, how these are defined, how they're calculated. Like a lot of things, it can look a little bit complicated, but it is pretty simple. But simple doesn't mean that it's not important. So now that we have this, we're going to move to video 2 where we build our aggregate expenditure model, and that is coming up as soon as you're ready to watch it.